Ivan today. As we promised in the previous lesson, again I came to you with Bank of Ceylon to do another lesson, another important lesson in the syllabus. So now we have been discussing many important lessons. Finally, I selected to discuss questions from last lesson, unit number 16, the last lesson in the syllabus. Unit 16, investment decisions. This is the last lesson in the syllabus. Right. So before starting today's discussion, I want your attention for a small article written by one of my former student. Now she's a main character, one of the main character in the country. Yes, your attention for this. Each and every one of you have a different story. Your story is different from my story. Each and every single person, you have different story and it is unique. Your story is completely different from my story. You have a complete different story. My story is different. But people want to know your story. What is emphasized in here, one day when people read your story, leave something for them to think. Leave something from your story for others to think. With that, we will start today's discussion from unit number 16, investment decisions. Right. In the previous session, we learned how to take a short-term decision in business. Unit 15, marginal costing, we mainly focus our attention, we paid our attention for short-term decision making. Short-term decision making, how to take a short-term decision. And the concept we discussed in the previous marginal costing are suitable only for short-term decision making. But in a company, they have long-term decisions also. So in this lesson, we are learning how to take a long-term decision for a company. How to take a long-term decision for a company. In the long-term decision making, we mainly pay attention to cash flows. The cash flows. Why? Here we incur large amount of money. Here we incur large amount of money for the anticipation of benefits in the future series of years. Then we have to consider present value of money. Here we learn how to calculate cash flows. The cash flows includes inflows and outflows of a project. These cash flows of an investment we divide into three mainly. Initial cash flows, which means the cash flows at the commencement of the investment. Example, purchase of machineries, then working capital requirement, initial cash flows. So during the investment period, you have operating cash flows. You have operating cash flows. So project income, project expenses, those are operating cash flows. So once you stop the investment, once you terminate, you have terminal cash flows. You can sell the machine and get cash, scrap value, residual value, recovery of working capital, those are terminal cash flows. Right. So using these cash flows, we can evaluate whether your investment is successful investment or unsuccessful investment. Right. In the investment decision, we have three techniques in the syllabus: payback period, which means number of years required to recover your initial investment, accounting rate of return, and net present value approach. Those are the areas we'll learn under advanced level accounting. We'll move to the question number 1. So question number 1, what is not a source of long-term finance? So what is not a source long-term finance? Right. And in a business, the business can be financed using equity and liabilities. A business can be financed through equity and liabilities. The liabilities we divide into two, non-current liabilities and current liabilities. Liabilities we divide into two, non-current liabilities and current liabilities. So this is long-term finance. The long-term finance, equity also we identify as long-term finance. Non-current liability and equity we identify as long-term financing method. The bank overdraft. The bank overdraft here, short-term, current liability. The debentures, non-current liability. The ordinary shares, equity. Ordinary shares, equity. The preference shares also, you can take part of equity or non-current liability. Lease right, non-current liability. But these four are long-term finance. These four are long-term finance. The question is, what is not a source of long-term finance? What's not a source of long-term finance? Then current liability part, you have bank overdraft. You have bank overdraft. Then the answer is the answer number 1. Question number 1, answer number 1. So what is the factor that a company should take into account when an estimation of cash flows? Estimation of cash flow in acquisition of a machine. And in the evaluation of cash flows of an investment, we consider certain cash flows. If you take, the question is, should take into account the sunk cost. The sunk cost we ignore. Why? You have already incurred it. Example, say you have done a market research to identify the feasibility of the investment. You have incurred a market research. You have done a market research and incurred cost. That's a sunk cost. You ignore it. Why? It's not important for the investment decision. You have already incurred it. The depreciation also we ignore. Why? It is not a cash flow. The depreciation is not a cash flow. The third one, fixed overhead. The fixed overhead also we ignore. Why? Fixed overhead, anyway you have to incur it. Whether you purchase this machine or not, whether you acquire this machine or not, you have to incur that fixed overhead. The book value. How you calculate book value? Cost minus accumulated depreciation. That also not a cash flow. It's also not a cash flow. You ignore that as well. Then we consider scrap value of the investment. You consider the scrap value of the investment. The scrap value of the machine you consider and identify that as a cash inflow at the end of the investment. So question number 3, what would not be included in a net present value of capital investment? Out of the items given, so what are the items you are not including? Any expenditure incurred after the payback period. Expenditure incurred we consider, the payback period will do later. Increase in working capital, cash flows you value on an incremental basis. This also we consider. The residual value of the investment, residual value or scrap value we consider is a cash inflow. Right. Interest expense, we leave that. Annual tax savings, the tax savings is an inflow. Tax savings and inflow, we don't consider interest expenses. Interest expense we don't consider. Why? The interest expense is a financing cost. The project financing is a separate decision. Project finance is a separate decision. So first of all, you have to decide whether you undertake the investment or not. First of all, you have to decide whether you undertake the investment or not. As an example, say your father is going to buy a car. He wants to buy a car. So first of all, he has to decide whether he buy a car or not. Investment decision is the buying of a car, acquisition of a car. Later only he will decide how to finance it, whether he goes for a bank loan, whether he goes for a leasing or any other personal loan. Those are financing techniques. The investment decision, we have to first decide whether to undertake the investment or not. First we have to decide whether to undertake the investment or not. The financing, interest expense, dividend payment, those are financing charges. The financing charges we don't consider in investment appraisal. Those are project financing method. Project financing is a separate decision. So first of all, you have to decide whether you undertake the investment or not. Then the answer would not be included. You don't include the interest expense. It's a project financing cost. The project financing cost we don't consider. So question number 4, why are cash flows discounted for investment appraisal? why cash flows discounted in the investment appraisal. So later on we will discuss how to discount and all. So now why we are doing that? So why we are doing that? Right. Now, as example, you can purchase a product, say a book, at 200 rupees. Now in this year, so this year you can purchase a book at 200 rupees. But when you come to the next year, so can you buy the same book at 200? The same product you can't buy at 200. Why? Currency nominal value appreciated. Nominal value appreciates, real value, the amount of goods and services you can consume, depreciate. The real value depreciate. Nominal value only appreciates. So because of that, we have to discount your cash flows. Later on we will discuss how to discount cash flows. Then why we are discounting? Currency nominal value appreciates, real value depreciates. The answer is, okay, the question was, why are cash flows discounted for investment appraisal? Rupees 1 now is more useful than 1 rupee you get in the future time. You will be very happy to get more money now. As human, if you get more money now, you can consume more goods and services. So why we are discounting that? 1 rupee is more useful than 1 rupee in the future. Reason is, currency nominal value appreciates, real value depreciates. To question number 5, the following items are related to a new project of a company. The question is, which of the above items are included in estimating cash flows? Out of these items, what are the items you include? You include in the cash flows of a project. Cost of labor required for the project. Cost of labor is a relevant cash flows of an investment. Right. Interest expense. In a previous question we discussed interest expense we don't consider. Why? Interest expense is a cost of finance, project financing. I explained you earlier, before financing the project, you should decide whether to undertake the project or not. We don't consider that. Additional working capital due to new project. We consider. Expected disposable value. Expected disposable value of the machine. Expected disposable value, residual value or scrap value we consider. We consider A, we consider C, and we consider D. A, C, D. We consider 4 items. Items A, C, D. A, C, D. Fourth answer to answer number 4. To question number 6. A company is considering acquisition of a machine at a cost of 800,000. At the cost of 800,000 initial cost. This machine will save 400,000 per annum in operating expenses. This machine will save. It's a cash inflow. Cost saving we identify as cash inflow next 3 years. Next 3 years. Using the following discount factors, what is the net present value of this? What is the present value? We'll take the question requirement is to note this. What is the present value of the invoice? The present value of annual cash flows. The present value of annual cash flows. We just cut this word. What's the present value of this investment? Present value, not the net present value. Present value of annual cash flows. The present value of annual cash flows. Present value of annual cash flows. So how you calculate it? So you can use this small schedule to calculate this cash flow. The year cash flows, discount factor, discounted cash flows. Year cash flows, discount factor, and discounted cash flows. So how many years this project goes? It's for next 3 years. It goes for next 3 years. Year 1, year 2, year 3. It says will save 400,000 annually. Each year it save 400,000. 400,000, 400,000, 400,000. Each year it saves you 400,000 rupees. So what are the discount factors given? The discount factors given: year 1, 0.9, 0.8 and 0.7. The discount factors given: the 0.9, 0.8, 0.7. Can multiply 360, 320, 280. You multiply with these two to get the discount factor. Discounted cash flows. To get the discounted cash flows, annual net cash flow, you multiply by the discount factor. Then you add it to 60, 960. And the question is the present value of annual cash flows. So don't misunderstand, not the net present value. Rectify the mistake. The present value of annual cash flows. Present value of annual cash flows. You can't take this 800,000. Sometimes you may be thinking now, You may think now why I ignored it. So the question wants present value, not the net present value. Present value of annual cash flows is, we got 960,000 rupees. We got 960,000 rupees. Do you have an answer here? 960,000. The answer number 4, fourth answer. A company is considering an investment in a project costing 2 million rupees. The initial investment, the initial estimates shows this project will earn a total net profit. Total net profit of 5 million. Total net profit of 5 million over a period of 5 years. Over a period of 5 years. But before considering following information, depreciation of 200,000 must be charged annually. Other cost will reduce by 100,000 annually. Other cost will reduce by 100,000 annually. The requirement, what is the accounting rate of return? Accounting rate of return based on initial investment. Accounting rate of return based on initial investment. Right. And this is a project selection criteria, selection method, investment appraisal techniques. To base certain companies, they want to consider about the project profit of the project, profit earned from the project. So those companies, they can use accounting rate of return. So how you calculate accounting rate of return? How we calculate accounting rate of return? Accounting rate of return equal average annual profit. Average annual profit divided by denominator. The denominator, question says the initial investment. Here the initial investment divided by initial investment into 100. Initial investment into 100. Average annual profit divided by initial investment into 100. Average annual profit. So how to calculate it? Average annual profit. Right. So what's the total profit given? The total net profit given is 5 million. Total net profit is given is 5 million. The 5 million given, the profit given 5 million. But the issue is that is total net profit. That is total net profit. We have to calculate annual profit. Project period how many years? Over 5 years. Then you get annual profit. You divide by 5, you get 1 million. You get 1 million. So for this you have to make adjustments. What are the adjustments to be made? It says clear before considering following information. So before considering the following information, then you have to consider them. A depreciation of 200 must be charged annually. Then what will happen to our profit? Due to depreciation, your profit will decrease. Calculated profit will decrease by 200 due to this depreciation. The other condition given, other cost will reduce. The other cost will reduce mean profit will increase. Profit will increase. Other cost. The other cost decrease mean profit will increase by 100. Then you get the average correct annual profit. Correct average annual profit. How much you get? 900. You can bring it here. 900. 900 divided by initial investment. The initial investment how much? The initial investment here, project costing 2 million rupees. 2 million in 1000 into 100. The 900,000 divided by 2 million into 100. You get 45%. 45%. What does it mean? What does it mean? Each 100 rupees you invest in this investment, each 100 rupees invest in this investment generates your profit of 45 rupees. When you each 100 rupees you invest in this investment, you get 45 rupees profit. Answer is 45%. The answer is 45%. Account rate of return 45%. So question number 8. A company is considering acquiring a machine at a cost of 800,000. At a cost of 800,000, this machine will saving is a cash inflow per annum in operating expenses. The saving of cost is a cash inflow next 3 years. So investment period is 3 years. After which it will have a no scrap value. There is no scrap value of this investment. Using the following discount factors, what is the net present value? So here the net present value. Here the net present value. We'll calculate it. The net present value, how you calculate? You discount your annual cash flows. You take the year net cash flows, discount factor and discounted cash flows. This investment goes for 3 years. Investment goes for 3 years. Starting from year 0, now first year, second year, third year, fourth year. Year 0, 1, 2, 3, 4. The annual cash flows. Investment cost of the investment is 800,000. It's a cash outflow. Initial cash outflow. The first year, each year you get 400,000 saving in cost. The cost saving 400,000 each year. First year 400,000, second year 400,000, third year 400,000. So this investment goes for only for 3 years. Now the discount factors. Discount factors. Year 0, now 1 rupee is equal to 1. Year 0, 1, 0.9, 0.8 and 0.7. Discount factors given 0.9, 0.8 and 0.7. Then you multiply these two and get the discounted cash flow. 800 into 1, negative 800. 360, 320, 280. And these three are cash inflows. Addition comes to, this is 300, 960, from that you minus 800. 960 minus 800, you get 160 as the net present value. Net present value. 916 flows present value. 800 is the initial investment, you get 160. So the net present value of this investment is 160,000. The net present value of this investment is 160,000. You calculate it by using the discount factors. 960 minus 800, you get 160. The answer number 2, second answer. The discounting methods have been used to evaluate an investment project over a life of 3 years. So the investment life is 3 years. The project will generate annual net cash inflow. Each year 2 million cash inflow. The 500,000 out of the initial investment can be recovered. Of your initial investment, 500,000 you can recover at the end of third year. Discount factors are given. The question requirement is, what is the present value of the project cash inflows? what is the present value of the project cash inflows. We'll calculate. So you can use the same chart. This investment also goes for 3 years. It wants cash inflows. It wants the present value of cash inflows. Each year how much? Each year 2 million rupees. Each year 2 million rupees. Year 1 2 million rupees. Second year 2 million rupees. Third year is the issue. The third year, it says 500 of the initial investment can be recovered. 500,000 from the initial investment can be recovered. Right. Now, annually, each year you get 2 million. Each year you get 2 million, but last year you get the scrap value. It's clearly mentioned here, 500 out of the initial investment can be recovered at the end of third year. Annually, third year you get annual 2000. In addition to that, you have scrap value of 500. So altogether 2500. Then the discount factors given. First year 0.9, second year 0.8 and 0.7. 0.9, 0.8 and 0.7. You can multiply and get the value. 2800, 1600, 1750. 1750. The addition comes to, addition of cash inflows comes to 55,150 to 5,150,000 is the present value of cash inflows. Present value of cash inflows, addition 5,150,000 rupees. Answer here, 5,150,000 to 5,150,000. The next question. The manufacturing company is considering to purchase a new machine replacing the existing machine. So their investment option is to replace the existing machine. The cost incurred to conduct the feasibility study. The cost incurred to conduct the feasibility study is 500,000. And this cash flow 500,000 is not a relevant cash flow. This 500,000 is not relevant for investment appraisal. Why? This has been already incurred. This has already been incurred by the company. Feasibility study cost, sunk cost, we have already incurred. The following estimates have been prepared in relation to this purchase. The cost of the investment is a cash outflow. Cost of the new machine cost is a cash outflow. The payback period of the investment is 3 years. The payback period. So what do you mean by a payback period? This is also one of the investment appraisal method. Payback period. The payback period, say you invest 1 million in the investment, you spend 1 million for the investment. The payback period means this is your net initial investment. The payback period means number of years required to cover this 1 million rupees. The payback period means number of years required to recover the initial investment. To recover the initial investment is the payback period. The number of years required to recover the initial investment. Right. Payback period of the new investment is 3 years. Sales proceeds. By selling the old machine, you will get 600,000. Useful life of the new machine is 4 years. The machine that you are buying, you can use for 4 years. Additional initial working capital, additional and initial working capital is 400,000 rupees. Assume that net operating cash inflow is equal. You have to assume that net operating cash inflow is equal each year. The requirements. Calculate the initial cash outflow. Initial cash outflow, not net cash flow. Calculate the initial cash outflow of the investment. Initial cash outflow of the investment and calculate the expected net operating cash inflow. We will do 10th one first. The question requirement is calculate the initial cash outflow. You have to calculate the initial cash outflow. Initial cash outflow. Initial cash outflow. At the commencement of the investment, what are the cash outflows? What are the cash outflows you found? We have 2 outflows. What are the 2 outflows? Cost of the new machine. The cost of the new machine is an outflow, an initial. Cost of the new machine. How much? 2 million outflow. 2 million outflow. Cost of the new machine. Cost of the new machine. And in addition to that, you had another additional initial working capital. Additional working capital. How much? 400,000. It's a cash outflow. The 2,400,000 is the net. What the question requirement? The net initial cash outflow. Cash outflow. Initial cash outflow is 2,400,000. And the question number. This is question number 10. The question number 11. The question number 11 is calculate the annual expected net operating cash inflow. Operating cash inflow. Operating cash inflow. How can you calculate? And here the payback period is given. Payback period is given. So how you calculate payback period? The payback period is equal. Payback period is equal net initial investment. Net initial investment divided by net annual cash flows. The payback period is equal net initial investment divided by net annual cash flows. Net annual cash flows, and you can use this formula. Why? The question is clear. It says assume that net operating cash flows is equal each year. Assume that net operating cash flows. Assume that net operating cash flows is equal. So then you can use this formula to calculate payback period, as the net cash flows are equal. How much is the payback period? It says payback period is 3 years. The payback period is 3 years, equal to 3. Net initial investment. The net initial investment. So how much net initial investment? We have to calculate. Right. This 2,400,000 is not initial investment. It's not net initial investment. Why? That is operating cash, initial cash outflow. 2,400,000 is not net initial investment. Why? There was another cash flow. There was another cash flow. This sales proceeds we didn't consider there. Sale proceeds we didn't consider there. That we have to consider. Then this 2,400,000 is an outflow. For that, this sales proceeds we have to consider. This sales proceeds we have to consider. It's an inflow. It's an inflow. And how much is the net initial investment? Net initial investment is 1,800,000. It's 1,800,000. Then you can calculate net annual cash flows. Net annual cash flows. The cross multiplication, net annual cash flows will be ₹600,000. The net annual cash flows will be ₹600,000. You can use this formula. You can use this formula. Why? The question clearly mentioned sales proceeds and assume that net operating cash inflow is equal. Assume that net cash operating inflow is equal. So you can use this formula to calculate. So then answer is ₹600,000. Now the question number 10 answer. The 10th question answer is this. Answer for 11th question is this. The 10th question answer is here 2,400,000 cash outflow, 2,400,000 annual expected net operating cash inflow, you got 600,000 rupees. 600,000 rupees. If all other factors remain constant, which of the following will lead to a decrease in net present value? If all other factors remain constant, which of these factors will lead to decrease in net present value? The decrease in residual value. So, residual value decrease. So, residual value decrease mean your inflow decrease. And in the computation of net present value, you consider inflows and outflows. The present value of inflows and minus outflows present value of outflows. And here decrease in residual value. The residual value is an inflow. Inflow decrease mean your answer decrease. The inflow decrease mean your answer decrease. Yes. Here a decrease in when your cash inflow decrease in residual value decrease, inflow decrease, then your net present value decrease. Yes. B. The decrease in required rate of return. And how you calculate the net present value? You take the cash flows, net cash flow, you multiply by the discount factor. Discount factors depend on company's required rate. If you expect a higher rate, then your currency depreciation is high. But here decrease in required rate, your required rate decrease, then currency depreciation is low. Decrease in the required rate, your required rate decrease, then you expect low decrease in currency depreciation is low, then your net present value is high. You expect low return, then your net present value is high. The question is decreasing net present value. No. You expect a lower return. Mean your present value will be high. Why? Your currency depreciation is low. In a situation where you expect low required rate of return, your currency depreciation is low. Your currency depreciation low means your present value is high. Here the question requires decrease. A company is considering to purchase a machine for 4,800,000 rupees. 4,800,000 rupees. Its useful life and residual value 10 years and 1,200,000 respectively. The straight line method is used to provide the depreciation. A net cash flow of 1,200,000 is expected each year. You expect a net cash flow of 1,200,000 from this machine. Required, calculate the payback period. Right. But this says how you calculate payback period. Earlier we discussed the meaning of payback period. The payback period means the number of years required to recover your initial investment. Number of years required to recover the initial investment, the payback period. The net initial investment, and here you expect each year equal cash flows. You expect each year equal cash flow. Machine purchase price is 4,800,000 rupees. If you are expecting each year equal annual cash flows, you can use this formula to calculate the payback period. If you expect each year same annual net cash flows, you can use this formula to calculate the payback period. The payback period equal net initial investment divided by net annual cash flows. Net annual cash flows. So what you have to keep in mind, you can use this formula only annual cash flows are equal. You can use this formula if your annual cash flows are equal. If annual cash flows are equal. Now as an example, if you get say you are renting an apartment, you purchase an apartment and you are renting it out. The rent income is same. That situation you can use this formula. Payback period in a situation where annual net cash flows are equal. But if you get different cash flows, now say you start a new showroom, you get different cash flows each year. Then you can't use this formula. Later question we will discuss how to calculate. The net initial investment, how much? The net initial investment 4,800,000. 4,800,000. So how much is the net annual cash flows? net annual cash flows 1,200,000 net annual cash flows. Years. The payback period is 4 years, which means within 4 years you can cover your initial investment. Within 4 years you can cover your initial investment. Payback period is 4 years. The payback period is 4 years. To calculate the accounting rate of return based on average investment. To calculate the accounting rate of return based on average investment. Based on average investment. And how you calculate accounting rate of return? In the accounting rate of return, we consider profit of the investment. In the accounting rate of return, we consider the profit of the investment. The accounting rate of return is equal. Accounting rate of return is equal average annual net profit divided by the denominator is given average investment into 100. This is accounting rate of return, average net profit divided by average investment into 100. Average annual net profit. So how you calculate average annual net profit? The net cash flows given. The net cash flows given. How much? Net cash flows, annual net cash flow given as annual net cash flows 1200. Annual net cash flow is 1200. But the formula, we want average annual net profit. We want average annual net profit. So from this you can minus depreciation. From this you can minus the depreciation to get the profit. How they calculate depreciation? So how they calculate depreciation? They say the straight line method is used. The straight line method is used. The straight line method is used. They use the straight line method. They use straight line method to calculate depreciation. The straight line method, how you calculate depreciation? Straight line method, cost minus residual value divided by useful life. Straight line method depreciation, cost minus residual value. The cost how much? 4,800, residual value 1,200, useful life 10 years. The cost is 4,800,000, residual value, scrap value 1,200,000, and useful life is 10 years. And you get depreciation 360. The average annual profit is 840. This you can use here, 840. So how you calculate it? From the cash flows, we minus depreciation. Why? In arriving at cash flows, you haven't considered depreciation. You haven't considered depreciation, so you deducted it. 840 is the depreciation annual average profit. and the average investment. The average investment equal initial investment. The initial investment how much? Initial investment 4,800,000. Initial investment 4,800,000. The plus scrap value. Scrap value 1,200,000 divided by 2. Why you divide by 2? Average of two values. The average of two values divide by 2. Then you can use it here. 6 million divided by into 100. You get the accounting rate of return. 840 divided by 3 million into 100, you get 28%. 28%. So what you learn here, how to calculate average annual profit. How you calculate? How you calculate? From the cash flows you deducted annual depreciation. So from the cash flows you deducted annual depreciation. 1,200,000 depreciation financial accounting you have learned, cost minus residual value divided by useful life, 360. Then you get the annual profit. Average investment, initial investment plus residual value divided by 2, answer is 28%. Answer is 28%. 28%. The payback period you got 4 years. The payback period is 4 years. This is 28%. So question number 15. To state whether the following will increase or decrease. The following will increase or decrease. The net present value of the investment, assuming other factors remain unchanged. Decrease in discount factor. The decrease now, say earlier you discounted at say 20%. Now you discount at 15%. Earlier you discounted at 20%, now it's decreased, you discount at 15%. Then what happens? Currency depreciation is low, your net present value will be high. When you decrease your discount rate, say 20% to 15%, your currency depreciation is low. Currency depreciation low means your net present value will increase. The net present value will increase. Net present value will increase. Increase. An increase in the initial investment. Initial investment. And how you calculate the net present value? The net present value is equal. Net present value is equal present value of cash inflows minus present value of cash outflows. Net present value equal present value of cash inflows and present value of cash outflows. Increase in initial investment. The initial investment increase mean your cash outflow increase. Your outflow increase. Outflow increase mean your net present value decrease. Outflow increase mean your net present value decrease. Net present value decrease. How you calculate the net present value? Present value of cash inflows minus present value of cash outflows. So initial investment increase mean your outflows are more. More outflows mean net present value decrease. A company is considering investing in a project costing 1,800,000. Initial cost 1,800,000. Initial estimates show the project will earn a net profit of 5 million rupees. The net profit of 5 million rupees over a period of 5 years. The following further information. Depreciation must be charged annually. Annually you have to charge depreciation. Other cost will reduce annually. What is the accounting rate of return of the project based on initial investment? Accounting rate of return based on initial investment. Right. So how you calculate the accounting rate of return? Accounting rate of return is equal average annual profit divided by now the denominator, it says based on initial investment. The based on initial investment into 100. Average annual profit divided by initial investment into 100. How much is the initial investment? Project costing 1,800,000. The project costing 1,800,000. The initial investment is 1,800,000. The annual profit we have to calculate. How you calculate it? The project will earn a total net profit of 5 million. The profit given how much? profit given 5 million, but that is for 5 years period. Annual profit is 1000. The 5 million profit is given for a period of 5 years. 5 million is for 5 years. Then annual profit is 1 million. But these items you have to consider. Depreciation. Annual depreciation we have to deduct. How much is it? A depreciation of 200 must be charged. Your profit will decrease due to depreciation. Other cost will reduce. The other cost will reduce. The other cost reduce mean profit will increase. The other cost. The other cost will reduce by 100,000. The other cost reduce mean profit will increase by 100,000. The profit is 900,000 into 100. This 100,000. And you can calculate the profit. The 50% is the accounting rate of return of this investment is 50%. Which means when you invest 100 rupees in this investment, you get a profit of 50%. Each 100 rupees generates you a profit of 50%. The answer is what it says, what's the accounting rate of return is? Accounting rate of return is 50%. Accounting rate of return is 50%. The project will generate annual net inflows of 4 million. Annual net inflows of 4 million. The 500,000 out of the initial investment of 9,500,000. So your initial investment is 9,500,000. Of that, 500,000 you can recover at the end of third year. You can recover at the end of third year. Right. What is the present value? What is the present value of cash inflows? The question is not net present value. Question is not net present value. Present value of cash inflows. The question is not net present value of cash inflows. Then we no need to consider initial investment. We no need to consider the initial investment. Why? Question wants the present value of project cash inflows. Project cash inflows. We will calculate the annual cash flows. You have to discount annual cash flows. You have to discount the net cash flows, discount factor, discounted cash flows. The project period how many years? Project period is 3 years. Year 1, 2, 3. The annual cash flows 4 million each year. The first year 4 million, second year 4 million, third year you have annual net cash inflow of 4 million plus this recovery of the initial investment. From the initial investment you can recover 500,000. Then the third year 4 million plus 500,000. So 4 million plus 500,000, 4 million 500,000. 4 million 500,000. Now you have a doubt. Why don't I take the initial investment? So why don't I take the initial investment? Why? The question is, what's the present value of the project cash inflows? The project cash inflows. Then you multiply by the discount factors 0.9, 0.8, 0.7. To 0.9, 0.8 and 0.7. You can multiply and get the values. Each year cash flows, you multiply by the discount factor and get the value. 3,600, 3,200, 3,150, 3,150. You can get the total. The 9,950,000. 9,950,000 rupees. The 9,950,000 rupees. The answer 9,950,000 rupees. The question is, what's the present value? Present value is 9,950,000. 9,950,000. It's not the net present value of the project cash inflows. The following information relates to a project. The present value of cash inflows, present value of cash outflows. State whether this project should be accepted or rejected based on net present value with a reason. Right. And in the syllabus, we are discussing 3 investment appraisal techniques. We are learning 3 investment appraisal techniques. What are those 3? payback period, accounting rate of return or average rate of return, and net present value. So these are the three methods we are learning in the syllabus: payback period, accounting rate of return, net present value. And then these three investment appraisal techniques. The payback period, we select the investment with the lowest payback period. In the decision, when you take based on the payback period, you select the investment with the lowest payback period. And in the accounting rate of return, we go for the highest rate of accounting rate. We accept the investment with the highest accounting average rate of return. The net present value, positive. We go for the highest positive net present value. Why? If your present value of cash outflows are more, you can get a negative net present value. You can get a negative net present value. So you select based on the highest positive net present value. And here our question is, based on net present value, whether you accept or not. The present value of cash inflows, 2,500,000. Inflows 2,500,000. The present value of cash outflows, 2,200,000. If the inflows are more than the outflow, you get a net present value, positive value of 300,000. You get a positive net present value 300,000. Why? Your inflows are greater than the outflow. The present value of cash inflows are greater than the present value of cash outflow. You accept this investment. Why? Positive net present value. As we have a positive net present value, you accept. State whether this project should be accepted or rejected based on net present value. The project should be accepted. The project should be accepted. Reason: positive net present value. Positive net present value, or present value of cash inflows are greater than the present value of cash outflow. The present value of cash inflows are greater than the present value of cash outflows. So question number 19. Assuming other factors to remain unchanged, state whether each of the following items increases or decreases the net present value of the investment. Net present value of the investment. Right. And how can you calculate the net present value? The net present value is equal the present value of cash inflows minus present value of cash outflows. The net present value of an investment is equal present value of cash inflows minus present value of cash outflows. The first one, an increase in expected cash inflows. The inflows increase. Inflows increase mean net present value increase. Inflows increase mean net present value increase. An increase in inflow. An increase in expected cash inflows. So the net present value will increase. The second one, an increase in discounting rate. Discounting rate increase. Your expected rate is high. Your inflation is high. Your expected rate is high. Your inflation rate is high. Then what happens? Your net present value will decrease. Net present value will decrease. Why? You discount your cash flows. You discount your cash flows at a higher rate. You discount your cash flows at a higher rate, then net present value decrease. The next one, an increase in the initial investment. Increase in the initial investment. The initial investment is a cash outflow. Net present value is equal to present value of cash inflows minus present value of cash outflows. An increase in initial investment. Initial investment increase mean cash outflow are more. Cash outflows are more. Then your answer will decrease. Answer will decrease. Answer will decrease. D, decrease in terminal cash flows. Terminal cash inflow. The terminal cash flows. The terminal cash flows mean once you terminate the investment, once you stop the investment, cash inflows and outflows we call terminal cash flows. Residual value of your asset, working capital recovery are terminal cash flows once you terminate the investment. Once you terminate the investment. The decrease in terminal cash inflows. Inflows decrease. Inflows decrease mean what happens? What will happen to your net present value? The inflows decrease mean your net present value also decrease. Inflows decrease mean your net present value also decrease. Decrease in terminal cash inflows, net present value decrease. A increase, B, C, D decreases. The question number 20, the initial investment is 5 million rupees. Discount factors given each year, cash flows, and discount factor at the rate of 10%. What is the net present value of this project? Net present value of this project. So how you calculate the net present value? You have to discount your annual cash flows. You have to discount your annual cash flows. Here, net cash flows, discount factor, discounted cash flows. Here, net cash flows, discount factor, discounted cash flows. And this investment goes from year 0 to 4. Year 0 to 4. Year 0, first year, second year, third year, fourth year. The annual cash flows. Initially, you have a cash flow of 5 million rupees. The 5 million of initial cash outflow. It's a payment. The first year 2 million. The first year 2 million. Second year 4 million. The third year 5 million. Fourth year 3 million. Year 0 outflow of 5 million, 2 million, 4 million, 5 million and 3 million cash flows. The discount factors. Year 0, now 1 rupee is equal to 1. 0.9, 0.8, 0.7 and 0.6. 0.9, 0.8, 0.6 and 0.7 and 0.6. 7 and 0.6. Now the net cash flows you multiply by the discount factor. These two you multiply. 5,000 outflow, 1,800, 3,200, 3,500, 1,800. You can calculate the net present value. You can calculate the net present value. The net present value 5,300,000 rupees. Each year cash flows you multiply by discount factor. The question is the net present value of this project is you got 5,300,000. A company is planning to purchase a new machine for 1 million rupees. The new machine for 1 million rupees and useful life is 5 years. Useful life is 5 years and no residual value. The useful life of this machine is 5 years but no residual value. And its expected annual net cash flows. Annual net cash flows. Annual cash flows. First year, second year, third, fourth and fifth years. Right. So what's the addition of this? ₹2 million. The addition of these net cash flows within 5 years is ₹2 million. What is the annual net profit? What's the average annual net profit of the above investment? What's the average annual net profit of this investment? Right. So how you calculate it? The question has given you net cash flows. Net cash flows. But the question requirement is to calculate average annual net profit. Average annual net profit. If you know the total net profit, you can divide it by project life period to get the annual net profit. And how you calculate the total profit? Profit of the investment equal, from cash flows you have to minus the depreciation. From the cash flows you have to minus the depreciation. So how much was the cash flow? So how much was the cash flow? The total cash flows of the investment is ₹2 million. The total cash flow of the investment is 2 million. Depreciation, the cost of the machine is 1 million. Cost of the machine is 1 million, no scrap value. Then how much the depreciable amount? Financial accounting, depreciable amount is cost minus residual value. Your residual value is 0. Residual value is 0. Then how much the full depreciation within 5 years? Total depreciation within 5 years, how much? 1 million. 1 million. Then the total profit of the investment is 1 million. Total profit of the investment is 1 million. This investment goes for how many years? It goes for 5 years. The annual average profit how much? 200,000 rupees. Average annual profit of this investment is 200,000 rupees. How you calculated? From the cash flows you deducted depreciation and 1 million for 5 years annual profit you divide by 5 years. So annual profit you got 200,000. The average annual profit how much? The average annual profit you got 200,000 rupees. 200,000 rupees. The next question, what is the accounting rate of return of this investment based on initial investment? Based on the initial investment. So how you calculate the what's the requirement? Average accounting rate of return. the accounting rate of return is equal average annual net profit. Average annual net profit divided by, based on what? Based on initial investment put. Denominator has been defined based on initial investment. Initial investment how much? Initial investment into 100. The average profit we calculated 200,000. Then investment, the initial investment, the initial investment of this project is 1 million rupees. Into 100. You get the answer as 20%. Accounting rate of return of this investment is 20%, which means each 100 rupees you invest in this investment generates you a profit of 20%. The accounting rate of return of this investment you calculated and you got 20%. It's 20%. To indicate whether the statement given in the table below true or false. The payback period considers all the cash flows of the entire investment. Right. The payback period. The payback period means number of years you want to recover the initial investment. Net cash flows. In a previous question we discussed how to calculate the payback period when the annual net cash flows are equal. But most of the project annual cash flows are not equal. Now here we will say first year 0 you spend 1000 net cash outflows. The first year you get say 400. Second year you get 500, third year you get 100, fourth year 500, fifth year you get say 300. And then you can calculate the accumulated cash flows. Accumulated cash flows. Year 0 you spend 1 million, no income, outflow 1 million. The first year you can recover 400,000 from your initial investment. So from your initial investment you can recover 400,000, then yet to recover 600,000. 1 million minus 400,000. Then the next year again second year you can recover 500,000, then you have to further recover 100,000. You have to further recover 100,000. Then the third year you get 100,000 and your accumulated cash flows become 0. Your accumulated cash flows become 0. This is your payback period. The third year you recovered your investment. Third year you recovered your investment, fully recovered. But in this investment, you get cash even after third year. So from this investment, even after third year, you get cash. But payback period, you don't consider them. In the payback period, you don't consider them. Cash outflows or inflows, after payback period, you don't consider. Then refer your statement. It says payback period considers all cash flows. No. The payback period doesn't consider all cash flows. Payback period means you covered the investment, even after covering, you get cash flows. You don't consider them. That's the main disadvantage of payback period. So statement, payback period recover, statement is false. Why? After payback period, you get cash flows. After payback period, you get cash flows. You don't consider them. Statement false. Statement false. Right. Now we discuss questions by covering all the areas in investment decisions, unit number 16. The main attention for accounting rate of return, payback period and net present value. So based on this concept, we will discuss recent past paper question. In recent past paper question, the rest to go through this 2019 A-level question. The 2019 question, the net present value of a project is 800,000. Which of the following would lead to a decrease in net present value? Decrease in net present value. And how you calculate net present value? So how you calculate net present value? The net present value equal, the net present value is equal the present value of cash inflows. Present value of cash inflows minus present value of cash outflows. Present value of cash inflows minus present value of cash outflows. Right. The question is decrease in net present value. Right. A, decrease in the discount rate. this decrease in the discount rate. Say originally it was 20%, now to 15%. So originally it was 20%, now it 15%. Originally you depreciated your cash flows at a higher rate, now you depreciate, now you discount at a lower rate. Now you discount at a lower rate. What will happen to your net present value? Net present value will increase. Net present value will increase. Why? Earlier you discounted at 20%, now you are discounting at 15%. Net present value increase. But the question is decrease. So first one we can't take. B. Increase in initial investment. Initial investment increase. Initial investment increase mean your cash outflows are higher. Initial investment increase mean cash outflows are higher. Then present value decrease. Outflow more mean present value decrease. Question requires that increase in initial investment, so we can consider this. C. Decrease in net operating cash inflows. Decrease in inflows. Decrease in inflows. Decrease in inflows. How you calculate net present value? The present value of cash inflows minus present value of cash outflows. Decrease in inflows. Inflow decrease. Inflows decrease. Then answer also decrease. Inflow decrease mean answer also decrease. But the question requires, yes, decrease. You can consider that also correct. Increase in cost of preparing project report. Cost of preparing project report. Increase in the cost of preparing project report. So this is not a relevant cash flow. It is not a relevant cash flow for this investment. You have already incurred that project preparation cost. Project report preparation cost we don't consider in the investment decision. Right? It says increase in project report. That's a sunk cost we don't consider. Then we consider only B and C. So B and C, we consider only B and C. The answer number 2. Second answer. The 2019 next question. The 2019 question, a company is considering to purchase a machine, the machine at a cost of 900,000. Useful life 5 years, residual value 100,000 rupees. The expected annual profit of the investment is 200,000 rupees, and its only non-cash expense is depreciation. The only non-cash expense is depreciation. The cost of the project is 900,000, useful life 5 years, residual value is 100,000. The expected annual profit of the investment is 200,000. Only non-cash expense is depreciation. To calculate the accounting rate of return. The accounting rate of return, how you calculate? The accounting rate of return is equal. Accounting rate of return is equal. Accounting rate of return is equal. Average annual profit divided by average investment into 100. Average annual profit divided by average investment into 100. Annual profit is 200,000 given. Annual profit is 200,000 given. 200,000. The average investment. So how you calculate average investment? Average investment equal, here the initial investment plus scrap value or residual value. Scrap value 100 divided by 2. Average of two values. Initial investment is 900,000. Residual value, scrap value 100,000. 900,000 plus 100,000 divided by 2. So why you divide by 2? Average of two values. How much? 500,000 into 100. 500,000 into 100. 40%. To get 40%. The accounting rate of return is 40%. The accounting rate of return 40%. Accounting rate of return is 40%. The calculation, average annual profit divided by average investment into 100. The average investment equal initial investment plus residual value divided by 2. Second part, payback period in years. So here payback period in years. So you can calculate here the annual cash flows profit 200,000 and initial investment is 900,000. So you identify here you have equal cash flows, annual cash flows. As these annual cash flows are equal, you can calculate the payback period. Payback period equal initial investment, the next initial investment divided by net annual cash flows. initial investment divided by net annual cash flows. So how much was the initial investment? The company is undertaking the new project, 900,000. Initial investment is 900,000. 900,000. Then net annual cash flows. Net annual cash flows. So how you calculate? The profit plus depreciation. Profit plus depreciation is your net annual cash flows. The annual profit given how much? The annual profit was given as the annual profit was given as how much? Annual profit is 200,000. Annual profit 200,000. You can add depreciation. So how you calculate depreciation in the financial accounting? Cost minus the annual depreciation. You can calculate. Cost is 900 minus residual value divided by useful life. Useful life is 5. The cost is given 900, scrap value 100 divided by useful life. And you get depreciation 160. So 360 is your annual cash flows. So you can use this formula as the annual cash flows are equal. For the profit, you add depreciation. Why you add depreciation? It's clearly mentioned. It's only non-cash expense is depreciation. It's only non-cash depreciation. Item is the depreciation we added. Then that 900,000 divided by 360,000, you get 2 years 2.5. You get 2.5. The 2.5 means the 2.5 years or 2 years and 6 months. 0.5 of a year means 6 months. 0.5 of a year is 6 months. Right. And the previously payback period, this we calculated 40%. Payback period years 2.5 years. 2 years and 6 months or 2.5 years. Initial investment you divided by net annual cash flows. The 2020 question. The 2020 LL question. This company is planning to purchase a new machine to commence a manufacturing business. The expected useful life is 5 years. The estimated cost and benefits of this project is given below. The purchase price of the new machine, installation cost, residual value at the end of 5th year. The residual value at the end of 5th year. Annual cash inflows. The working capital requirement of the project at the beginning is 150,000. It can be recovered at the last year. The initial cash outflow and the cash inflow at the final year. How many years? 5 years. 5th year cash flows respectively. This is a MCQ questions. You have answers. We'll make the calculations. The investment, the requirement is initial cash outflow and the final year cash. If you take year wise, year 0 and final year 5th year cash flow. Year 0 and 5th year cash flows. The purchase price. The first you have purchase price of the new machine. If you purchase, you have to pay it now. The purchase price, how much? 1,100. Now you pay cash outflow. Purchase price, cash outflow. If you purchase, you have to install it. Installation cost. Now you have to pay installation. How much? 200,000 cash outflow now. The residual value of the machine at the end of year 5, 5th year residual value. It's clearly mentioned at the end of year 5. Residual value. Scrap value you get at the end of 5th year. How much? 100,000 is the cash inflow. 100,000 is the cash inflow. Annual cash inflows. Next one is annual cash inflows. How much? 335,000. Annual cash flows. Annual cash flows year 0 you don't get. At the end of the investment, 335. The working capital requirement of the project. The working capital requirement of the project at the beginning will be 150. Working capital at the beginning 150. You pay it now. And it can be recovered. This 150 you can recover in the last year. So that will be recovered, will be received at the end of the investment. Working capital you incur now and you can recover at the end of the investment. So purchase price now you pay, you install it now you pay, residual value at the end of the investment, annual cash flows each year, working capital year 0 now you pay and later you recover. Then you get the total 1,450,85,585. 585 and 1,450,000. 1,450,000. To check the answers. Initial cash outflow how much? 1,450,000. Answer number 4 and 5 you have. Outflow in the final year. 585,000. 585,000. Answer number 5. Look at number 27. This company is considering to acquire a new machine to diversify the business. So the cost of this machine is 1,700,000. Expected useful life is 5 years and a residual value 200,000. The management accountant of the company has evaluated the project and calculated the payback period is 2 years and 6 months. The payback period is 2 years and 6 months. The net cash flow estimates of the project are given below. First year, second year, third year, fourth year. Right. Indicate the following for the year 3, third year. Third year, cash flow is missing that you have to calculate, and profit we'll calculate. And so how you calculate the payback period? And it's clear, this investment annual cash flows are different. These investments annual cash flows are not equal. See, 600, 750, 450, 425. Then you have to calculate the payback period using year net cash flows, accumulated net cash flows, accumulated net cash flows, year cash flow and accumulated net cash flow. This investment goes for 5 years. 0, 1, 2, 3, 4 goes for 5 years. The net cash flow. So how much is the net investment? The cost of this machine is 1,700,000. Initial net cash flow 1,700,000. 1,700,000. Then the annual net cash flow is given. First year, second year, third year question mark, fourth and fifth years. The first year how much? 600,000. Second year 750,000. Third year is the missing value. Again fourth year given as 450. Fifth year also given, but we don't want it. 425. Then they say, the question says payback period of this investment is 2 years and 6 months, 2.5 years. 2 years and 6 months mean 2.5 years. If you calculate the accumulated cash flows, when you calculate the accumulated cash flows, year 0, no inflow, outflow is 1,700,000. Year 0, no cash inflow, the outflow. The first year of that you recover 600,000, 1,100,000 to recover. 1,100,000 to recover. Then the next year, second year, you receive another. Second year, you receive another 750. Another 750. Then how much you recover? You have to recover further. Second year, you have to recover further. 1,100,000, you get 750,000. You have to recover 350,000. You have to recover 350,000. Then the payback period. Payback period, it says in between year 2 and 3. Read it clear. Read it clearly. 2.6 months, 2.5 years, 2 years and 6 months. In between second and third year, exactly 2.5 years. Then now, by the end of the second year, you have to recover 350,000 rupees. By the end of the second year, you have to recover 350,000. Then, so at the end of third year, you should have positive 350. You have to have positive 350. Why? Half only you have to recover. 2 years and 5 months. So 2 years and 6 months. So then annual cash flow, half should be positive. The half should be positive, mean here it should be 700,000. 700,000. Why? The payback period is 2.5, 2 years and 6 months. 2.5 years. By the end of the third year, you have to have positive net cash flows of 350. Why? Within 6 months you can recover. Within 6 months you can recover. Then third year, your net cash flows should be 700,000. Third year cash flow should be 700,000. Here the answer is 700,000 rupees. The profit, how you calculate? Profit you calculate from the cash flows. When you minus depreciation, you get the profit. The profit equal net cash flow of the third year minus depreciation. Net cash flows minus depreciation. The net cash flow, how much you got? You calculated 700,000. Depreciation, financial accounting depreciation. The financial accounting depreciation, how you calculate? The financial accounting depreciation, cost minus residual value divided by useful life. Here residual value, useful life. The residual value is 200, useful life is 5 years. Then you get depreciation of 300,000. Depreciation 300,000. Then the profit will be 400,000 rupees. The profit will be 400,000 rupees. Net cash flows you minus depreciation. Third year net cash flow we calculated 700,000. From that you minus the depreciation, you get the profit of 400,000. The profit is for the year 3. The profit is 400,000. Right. 400,000. Right. And now we discuss main areas in the syllabus by way of 10 seminar series under this concept of NanaJaya program. It was a long journey. You see these videos and the screen and myself, but behind this we had many people who help us. So honestly, the Bank of Ceylon wanted in this situation you to learn something from this series of seminars. And before winding up this series of seminars, I must thank to many people who were behind the screen. Right? And they nicely presented you, but behind the screen there are many people involved them to bring this presentation a success, a seminar series a success. Right? And these, out of the people to whom should I thank, I have to mention especially the chairman of Bank of Ceylon, Mr. Kanchana Ratwatta, the general manager Bank of Ceylon, Mr. K.E.D. Sumanasiri, and all the management of Bank of Ceylon, Chief Marketing Officer Mr. Samir Liyanage, Assistant General Manager Marketing Mr. Anura Hettiarachchi, and Mrs. Tarindu Vanikasuriya in the marketing department at the staff of marketing department. And this recording was made in BOC TV studios located at 15th floor of Bank of Ceylon. from the day we started, they had a warm welcome. And I especially must thank to the staff of POC TV team. And they warmly welcomed us and they treated us well. They are in the manager TV BOC, Mr. Nilantha Agampodi, Mr. Salinga Kodikara, and Mr. Lakshan Ranagala, and the entire BOC TV team. They have a nice welcome from the very first day until we conclude this seminar series. They were with us and they help us a lot in finalizing this project. And this presentation was amazing presentation, was nicely made by Mr. Ravin Pranandu. I have to thank him also. And finally, I should thank you for watching this seminar series. Finally, thank you very much for all the support you gave. And until we meet with a new project, we'll meet again. And bye bye.